Bismillahirrahmanirrahim. Assalamu alaikum, my dear students. Now, in our previous lecture, we started discussion on the balance of payments. Since this is a particularly difficult topic, or most students find it one of the most difficult topics in economics, at least at the introductory level, then I will try to go a little bit slower than I have been going in the last few lectures in order to ensure that you do assimilate and understand the concepts that are being thrown at you. So pay attention and hopefully we'll cover a lot of ground in this lecture and maybe another half lecture which comes after this. Now, in discussing the balance of payments, I mentioned that we were really talking about the transactions that the citizens or the residents in one country have with the rest of the world. We simplified our analysis to a world where just two countries existed, that is Pakistan and the United States. And there were hence two currencies, that is the US dollar and the Pak rupee. And we noted or looked at the different transactions that could happen between Pakistan and the United States. Some of those transactions were obvious, and we've talked about those in our earlier lectures. For example, exports of goods from Pakistan to the US, imports of goods from the US into Pakistan. Note that our exports are their imports, and our imports are their exports. So it's mirror opposite images of each other. Then we also noted that there could be transactions like foreign investment coming in or debt transactions, that is Pakistan taking on new debt from the United States or paying off existing debt to the US. Similarly, if some US investors come and invest in Pakistan, that would be a case of a foreign transaction as well. Similarly, if Pakistani investors invest in the US, then that's also a foreign transaction. Now, all these different transactions, I said, gave rise to the demand and supply for foreign currency, right? So when Pakistanis want to export something, when they export it, the people in the US who are buying our goods will pay in US dollars. So when these exporters get those US dollars that come from abroad, then they need to convert those US dollars into rupees, right? Because it is the rupees that the exporters can spend in Pakistan. That's the currency that's used here. Similarly, when foreign investors come from abroad, they bring US dollars with them, but eventually they have to convert those US dollars into rupees, right? Because it's the rupee currency which works here. This is the supply side. What about the demand side? If a person in Pakistan wants to import something from the US, then obviously he has to pay the US producer who is sending the goods to Pakistan in US dollars, right? So he has to buy US dollars from the local foreign currency market. Similarly, if somebody wants to go to study to the US or wants to travel to the US and wants to take some dollars with him or her, then similarly he would go to the market and want to demand dollars. So within the Pakistani context, there is both demand and supply of dollars. There are buyers of dollars and there are sellers of dollars. And this gives rise to the market for foreign exchange. Just like any other market, there are buyers in that market and there are sellers in that market. The key thing to note is that we have replaced the good that we usually talk about in any market by the US dollar. So it's the currency now which serves as the good. So the key thing to remember here is that on the horizontal axis, you do not have the quantity of any good. The quantity of the good is the quantity of US dollars. If you're talking about the market for US dollars in Pakistan, then on the horizontal axis, the good that you are talking about is the US dollar, that currency paper. And on the vertical axis, you will have the price per unit of that good. So that is the price per dollar. but the price per dollar would simply be the number of rupees you have to pay in order to obtain $1 or the currency note for $1. But that ratio, that is the number of rupees, the amount of rupees that you have to pay in order to get $1 is nothing but the exchange rate, right? We talk about exchange rates in newspapers and television. So the price of the US dollar is actually nothing but the exchange rate. So now that we have set up these axes, that is on the horizontal axis we have dollars, on the vertical axis we have the exchange rate denominated in rupees per dollar. We can now draw the traditional demand and supply curves, and we saw how these were drawn in our previous lecture. And the next question obviously was, what would be the factors which cause shifts in the demand and supply curves? Naturally, when we talk about demand and supply curves, the question of what factors could cause shifts in the demand and supply curves automatically arises. This is something that should now be embedded in your thought processes. Anyway, well, the factors which cause shifts in the demand or supply curves for US dollars would simply be factors which are not shown on the vertical axis. So any other factor which causes the supply of US dollars to change will cause the supply curve for US dollars to shift. So, for example, if Pakistani exporters manage to sell more exports and get more dollars from abroad, then that would cause the supply curve to shift to the right. Similarly, if more people wanted to travel to the US and their demand for US dollars went up, then the demand curve for US dollars would shift to the right. So note this, the relationship between these other factors and the movements in the supply and demand curves that they cause. All these other factors are factors that are not on the vertical axis. If there was a change in price, that is a change in the exchange rate, we would be talking about movements along the demand and along the supply curves. But if any other factor changes, then we are talking about shifts. Now the next stage in our discussion will be about the exchange rate. That is whether the thing that appears on the vertical axis, whether that is floating or fixed, and what implications does it have for the market and when the supply and demand curves change. So let's turn to this part of our discussion. Now, a fixed exchange rate regime is simply one in which the government or the central bank fixes the exchange rate at a certain level. So if today the Pakistani rupee is 58 rupees to the dollar, then the government would fix that exchange rate to 58 rupees to the dollar. So everybody would have to accept that exchange rate. Note that this is very similar to when the government set price ceilings or price floors in our discussion in microeconomics. So when the government sets price ceilings and price floors and the market equilibrium happens somewhere else, you know what happens. There are shortages and surpluses. And the same situation would arise here. We will look at that shortly. But I'm just trying to explain to you that when the government fixes the exchange rate, conceptually it's very similar to when the government fixes the minimum wage, that is, sets a price floor, or a maximum ceiling, that is, the maximum price of medicines. Only that in the case of fixing the exchange rate, the government fixes it in both directions. That is, it's both a price floor and a price ceiling. It's just a fixed price. And that's what the government decides. In a floating exchange rate, by contrast, the government really doesn't care about where the exchange rate goes or what happens to the exchange rate. And it lets the demand and supply factors in the economy, in the market for foreign exchange, determine the price of foreign exchange. So what would happen if the demand for foreign exchange or the demand for dollars increased? Think about it. In a demand-supply graph, if the demand curve shifted to the right, then the price of dollar, that is denominated in rupees per dollar, would increase. So if the dollar is trading at 58 rupees to the dollar, it might go up to 60 rupees to the dollar. depending on the increase in the demand or the magnitude of increase in the demand. Similarly, if more export proceeds came into Pakistan and the supply curve shifted to the right, what would happen to the price of dollar? Yes, the price of the dollar would fall. That is, the rupees per dollar would fall from, let's say, 58 rupees to the dollar to 54 rupees to the dollar. Let's evaluate how this difference between fixed exchange rates and floating exchange rates plays out in the foreign exchange market when we look at it in a graphical manner. Let's go to some graphs. Now let's first evaluate what happens when we are in a fixed exchange rate regime setup. That is, the government has fixed the exchange rate at P1, that is 58 rupees to the dollar. Let's say we start at equilibrium point E1, that is the intersection of the demand curve D1 and the supply curve S1. The quantity of dollars in the market at this level, the quantity of dollars that clear the market at this price is, let's say, $1.0 billion. Now let's say what happens when the demand curve shifts to the right. That is, there is an increase in the demand for dollars. Let's say the demand curve shifts from D1 to D2 and the magnitude of the increase in demand is $200 million. And this could arise because of a higher demand for imports from the US, or more people traveling to the US, or more students going there, etc., etc. Now let's first analyze what would happen if the exchange rate were not fixed. That is, if the exchange rate were allowed to move up and down. That is, there was no restriction on what price could obtain in the market. If that were the case and the demand curve shifted to the right, equilibrium would move to a point like E4, where the new price, that is the new exchange rate, would be something like 65 rupees to the dollar, whereas the equilibrium quantity that cleared the market would be higher than before. That is, it would be something like $1.1 billion. Note why an increase of 200 million in demand only causes an increase of 100 million in the equilibrium quantity. That is, in moving from Q1 to Q2, the quantity only increases by 100 million. Why is this? This is because of the market mechanism. As the equilibrium point moves from E1 to E4, the price of the dollar increases. And this chokes off some of the demand at source. That is, it reduces some of the incentive to buy dollars. And therefore, the initial 200 million demand, the net effect that it has on the market clearing quantity is halved. That is, it falls to 100 million. Now, this is the case when the exchange rate would be allowed to move freely. That is, the exchange rate would be freely floating. What happens if the government did not want the exchange rate to go up or higher than rupees 58 to the dollar? Well, if the government wanted to ensure that, it had to do two things. It could do one of two things. It could either try to reduce the demand that had increased by 200 million. So it could either try to shift the demand curve back from D2 to D1. It could try and do that by, let's say, imposing import restrictions, right? So it might not allow the people who want to buy more US imports to buy those imports. Or it could stop people from going to the US to study, right? That could also be a way of bringing the demand curve back. But assuming the government doesn't want to do that, what other option does it have in order to ensure that the price in the market remains at P1? Well, the other option that the government has is simply to move the supply curve to the right. That is, shift the supply curve from S1 to S2. How can the government shift the supply curve to the right? It can pump dollars in the market. Where can it pump dollars from? Well, usually the government has its own stock of dollars lying with it. So it can just unload some of those dollars in the market. and that would shift the supply curve to the right by exactly 200 million, right? So the government would inject dollars in the exact amount that demand for them has increased. And now the new equilibrium that would be reached would be E3. So as you can see, the price has remained the same at rupees 58 to the dollar, but the equilibrium quantity has now gone up by the entire 200 million. Why has this happened? This has happened because the market mechanism has not been allowed to play its role, and the entire increase in demand for dollars has been accommodated by the government by increasing the supply of dollars commensurately. So you saw, my friends, how the market equilibrium implications differ from when you have a fixed exchange rate regime to when you have a floating regime. In a floating regime, you let the market mechanism operate and you let the new demand and supply curves determine the new point of equilibrium. But when you have a fixed exchange rate regime, the government has to usually offer a compensating increase or decrease in the supply or demand sides of the market in order to ensure that the exchange rate remains the same. Now, in this particular example, we saw what would happen when the demand curve shifted to the right. That is, whether the government could reduce the demand curve back to its original level, or whether it could increase the supply and therefore shift the supply curve to the right. Those were the two options available to the government if it wanted to keep the exchange rate constant. What would happen if the supply of the foreign exchange or the dollars increased? What can the government do in this case if it wanted to maintain a fixed exchange rate? Let's go back to our slide. Now, in this case, let's imagine that we still start at E1, right? And let's see what happens if the supply curve shifted to the right. And this could happen because the exporters get more dollars from abroad, they're able to sell more exports, or more foreign investment is coming into the economy, right? All of these factors could shift the supply curve rightwards from S1 to S2. And let's say the increase in the supply is to the tune of $200 million. So that's the magnitude of the increase in supply. Now, if the market mechanism were allowed to operate, the new equilibrium point would be, yes, E2, right? Where a lower price or a lower exchange rate would obtain, that is, you would have something like rupees 50 to the dollar, and the quantity would again be something between 1 billion and 1.2 billion, and in this case we can assume it would be 1.1 billion, like in the previous case. And that's how market would find its new equilibrium. But this would be when the exchange rate is floating. What if the exchange rate is fixed? What can the government now do? Well, the government in this case has one real option actually, and that is to increase the demand for dollars in the market. That is to shift the demand curve from D1 to D2. And this would ensure that equilibrium would again be established at E3. But the government would have to increase the demand for dollars by how much? Yes, by $200 million exactly, because it now wants to accommodate all the increase in the supply of dollars. Now, the question that arises is that how would the government generate this demand? Well, the government would simply generate this demand by going into the market and buying this foreign exchange from the market. Remember that earlier when we were talking about the shift in the supply curve to the right, that is the government injecting US dollars in the market, again the government did the same thing. It went into the foreign exchange market and it dumped $200 million. In this case, it simply goes into the foreign exchange market and it buys $200 million. The earlier intervention that the government did is called sales of foreign exchange reserves. And this intervention in which it demands foreign exchange or buys foreign exchange is called purchases of foreign exchange by the government, right? And these two are both types of intervention that the government can undertake in order to ensure that the fixed exchange rate is maintained. So my friends, that was how the market would respond when you have fixed and floating exchange rate mechanisms. It's not very difficult, but you need to be comfortable with how the supply curves shift and in what direction would the compensating intervention have to take place from the government in order to ensure that the exchange rate was remain constant. Note that there are two terms that can be introduced at this stage. There is appreciation of the currency and there is depreciation of the currency. And similarly, you could have devaluation and revaluation. When you're talking about appreciation of the currency, then you are essentially in the realm of floating exchange rates. That is, when you allow the rupee to dollar exchange rate to find its own new value, and if in finding that new value, the rupee to dollar rate plummets, that is, if the rupee to dollar rate was 58 rupees to the dollar and it goes to 50 rupees to the dollar, you say that the rupee has appreciated. Why are you saying that the rupee has appreciated? Appreciation has something to do with an increase in the value of the rupee. So earlier, when $1 was able to buy 58 rupees, now $1 can only buy rupees 50. So the value of the rupee has gone up. This is called appreciation. What is depreciation? Depreciation is the exact opposite. When the rupee loses value relative to the dollar, that is, when you move to a higher price equilibrium in that foreign exchange market, that is, the rupee dollar parity increases from, let's say, 58 rupees to the dollar to 65 rupees to the dollar, that's called depreciation of the rupee, that the rupee currency has depreciated or lost value. Now, what are the two equivalent terms when you have fixed exchange rate regimes? Now, when I say fixed exchange rate regimes, usually it does not mean that the exchange rate is fixed forever. Sometimes it is possible for governments to keep the exchange rate fixed for a long time. But this depends on the adequacy of foreign exchange reserves and a number of other factors which we will address shortly. So sometimes governments do change the level of the exchange rate from time to time. And this was the regime that Pakistan had until very recently, when it moved to a kind of a managed float system. Earlier on, the rupee was fixed and was changed every, let's say, year or 8 months or something like that. And those changes, abrupt changes in the rupee dollar parity, were called revaluations and devaluations. What are revaluations? A revaluation would be when the government decided that the exchange rate would now change from 58 rupees to the dollar to, let's say, something like 50 rupees to the dollar. So it has revalued. Revaluation also has something to do with an increase in the value of the rupee. What is devaluation? I think you all know what devaluation is. Devaluation is simply when the rupee dollar parity increases, that is, the number of rupees that a dollar can buy are increased, and the government does it. So when the government does it, it's called devaluation. When the exchange rate itself lost value, then we said, yes, that was depreciation. So when devaluation takes place, the rupee dollar parity jumps from something like 58 rupees to the dollar to 65 rupees to the dollar. So this is an example of the difference between devaluation and revaluation on the one hand, and depreciation and appreciation on the other. The first two arise in the context of fixed exchange rate regimes, and the latter two arise in the context of floating exchange rate regimes. Now let's move at this stage to our next point of discussion, and that is understanding balance of payments accounts. It was very important for you to understand the market for foreign exchange before we get to the balance of payments accounting. But now you will notice that it will become easier for you to understand balance of payments accounts. Let me go to a slide to illustrate what balance of payments accounts are and what the different components in there mean. Let's go to our slide. Now, the balance of payments is like any account that you could have in a bank. This is the account, you could say, for the whole of the country in respect of the country's foreign transactions. Now, the foreign transactions that any country can have can be broadly divided into two subcategories. That is, current account transactions and capital account transactions. I will explain to you in a short while what this distinction actually means. Let's just take it that there are two sub-accounts to this balance of payments account. Now, in the current account, you have three sub-accounts that are further subcategories. You have the goods account, the services account, and the income and transfers account. Now, within the goods account, you have exports and imports, right? So you can have goods which you export outside and goods that you import from outside. Now, understand the signs that I have used in the balance of payments. We have some items which are shown with a positive sign, some with a negative sign, and some with both positive or negative. What do these mean? Well, in the context of the foreign exchange market graph, the positive sign here would mean anything that increases the supply of dollars or anything which causes the exchange rate to appreciate. That is, puts a downward pressure on the rupee-dollar parity. So any item here which causes a downward pressure on the rupee-dollar parity, if the exchange rate were floating, is shown with a positive sign. So now think about exports. When Pakistanis export goods to the US, more dollars come in. What do those dollars do? They shift the supply curve to the right. What does that do to the exchange rate? It tries to push the exchange rate down. That is from 58 rupees to 50 rupees. And that is why it is shown with a positive sign. Imports have the exact opposite effect. Now, all the other signs follow the same logic. I leave it to you to understand why this is the way it is, but I'm sure you will be able to trace the logic very simply. Now, the services account, which is also called the invisible balance, it is called invisible because you don't actually see services being transferred across countries. So you might have Pakistani students going to the US and getting education there. That's a service that is being provided to the Pakistani students, but there is no actual physical transfer of service from the US to Pakistan, like in the case of goods. It's an import of service when the US trains our students, but it's not something which can be seen as physically being transferred from the US to Pakistan. Thirdly, we have the income and transfers account. Again, you could have factor incomes from abroad. That is, your workers outside might remit their salaries back home to Pakistan. You could have people working abroad or firms, Pakistani firms operating abroad, sending their dividends or profits back home. Similarly, you could have people who have invested outside the country in fixed income securities such as bonds, or they have invested in bank accounts, and there is interest which is earned on these bank accounts and the money is sent back home. So this would also be something which would be shown with a positive sign. On the negative sign, you could have factor payments that are going abroad. You could have multinational corporations operating in Pakistan who send their profits back to the US. Or you could have interest payments that Pakistan makes on its foreign debt. So if some people have lent some money to Pakistan and Pakistan has some interest payments to make on those debts, then that interest cost would also be reported in this part of the balance of payments, that is under the current account balance under income and transfers. Note that wherever we have a combination of more than one item, that is one or more plus or minus items, the total of those two items can either have a positive sign or a negative sign. So look at the item number 1I, that is the goods or visible balance. There, if you have more exports than imports, then the goods balance will be a positively signed balance, will be in surplus. Whereas if the imports are more than exports, then the goods balance will be in deficit, that is, it will be negatively signed. Similarly, for the services account, for the income and transfers account, and for the current account as a whole. If the total of 1, 2, and 3, the small Roman 1, 2, and 3, is positive, then the current account balance will be in surplus. If the total of 1, 2, and 3 Roman is negative, then the current account balance will be deficit. That is, you'll have a current account deficit. We can now turn to the capital account. Now, the capital account can have 4 major types of transactions. You can have incoming foreign investment, or incoming foreign portfolio investment, or other private capital. Portfolio investment is simply when foreign citizens, that is, let's say a US citizen invests in Pakistan's stocks and bonds and shares. Whereas foreign direct investment would be when they come and set up factories, and I think I mentioned this distinction earlier as well. You could have the mirror image of that, that is, if Pakistanis invest abroad, if Pakistanis take money out from Pakistan and go and invest in the US, either set up plants and factories there or invest in US stocks and bonds, then you would have the corresponding outgoing FDI and FPI entries in the capital account. Then any debt that Pakistan contracts from abroad, that is, if Pakistan borrows, let's say from the IMF or the World Bank, or in this case from the United States, then that money that comes in would also be recorded in the capital account. Also, if Pakistan receives any humanitarian assistance or grant aid, that is, money that does not have to be repaid by Pakistan, will also be recorded in this category under capital account. Then finally, we have payments of debt principal. That is, when Pakistan repays its debt, not the interest on debt. This is the repayment of the actual debt. So if Pakistan borrowed rupees, let's say $100, and then paid interest of, let's say, $10 every year, then the interest would be recorded in the current account, but the retirement of the principal, when Pakistan pays back all or part of the principal amount of 100, that would be recorded in the capital account. Similarly, if Pakistan extended humanitarian assistance to a neighboring country, to a country in need, and that was money that did not have to come back to Pakistan, then those would be aid outflows and would be recorded with a negative sign in the capital account. Now we turn to the third major sub-account in the balance of payments, and that is the foreign exchange reserves account, or the changes to official foreign exchange reserves of the government. And this is where the government intervention comes in. We've been talking about earlier how in a fixed exchange rate regime, the government has to supply foreign exchange or dollars to the market when there is an increase in demand, for example, or has to create the demand for dollars in the market when there is an increase in supply. And the government has to do that in order to keep the exchange rate fixed. Now, when the government supplies foreign exchange to the market, that is, when it sells its foreign exchange or its dollars into the market, that would be shown with a positive sign because it increases the supply of dollars. On the other hand, when it purchases foreign exchange in the market, then it reduces the supply of dollars in the market, and therefore it is shown with a negative sign. It is the combination of 1, 2, and 3 which should equal 0 always. That gives the famous statement that the balance of payments always has to balance. That is, the sum of 1, 2, and 3 always has to be equal to 0. This is an accounting requirement. Just like assets and liabilities balance, we have to have 1, 2, and 3, the sum of the current account, the capital account, and changes to official foreign reserves equal to 0. Now, there are two things about the balance of payments that I still haven't talked about, which are very important and basic things. One relates to the distinction between the current account and the capital account, and I will come to that shortly. And the other one relates to the notion of equilibrium in the balance of payments. When you say that the balance of payments always balances, does it mean that the balance of payments is in equilibrium always and that the governments should never worry? No, that is not what it means. And we'll address this question in a short while as well. But before that, let me try to just clarify in your minds the relationship between the changes to the foreign exchange reserves part of the balance of payments and the other two parts, that is the current account and the capital account. And this comes out very nicely from the intuition we have gathered through our discussion of the foreign exchange market. Now think about what would happen when you have a balance of payments deficit. And when I say a balance of payments deficit, I mean that there is a combined deficit on the current account and the capital account. That is, both the sign of the current account and the capital account is negative. Now, whether when you have a negative sign on the sum of the current and capital accounts, that is on the sum of 1 or 2, whether this has any implication in terms of your foreign exchange reserves depends again on whether you have a fixed exchange rate regime or a floating exchange rate regime. Now think of what would happen if you had a floating exchange rate regime. So suddenly you have a deficit on your current account and a deficit on your capital account, or that the combination of those two, 1 plus 2, is in the negative. You might have a $100 million surplus on the current account but a $200 million deficit on the capital account, so that the sum of 1 and 2 is in the negative, minus 100. So what are the implications if you have a floating exchange rate regime? When you have a negative sign on this 1 plus 2, the implications in the foreign exchange market are that the demand for dollars is increasing. That is, there is a pressure on the rupee-dollar parity to increase. That is, to rise from, let's say, 58 rupees to the dollar to 65 rupees to the dollar. Because a negative sign corresponds with an increase in demand for dollars. Could be caused by an increase in the exports that Pakistan is making from the US, could be caused by an increase in debt payments that Pakistan makes to the US, etc., etc. So once you have a deficit on these two accounts, 1 plus 2, this causes an upward pressure on the rupee-dollar parity. But because you have a floating exchange rate regime and there is no restriction per se on the exchange rate, what will happen to the exchange rate? The exchange rate will simply rise to the new level, from 58 rupees to the dollar to 65 rupees to the dollar, or if need be to 72 rupees to the dollar. And the problem will be eliminated because of the market mechanism. As the exchange rate rises, the demand for dollars will fall because the rupee is now become cheaper and the dollar has become more expensive, and therefore many people who wanted to buy the dollar would not buy the dollar. So the market mechanism would come into play and restore equilibrium in the sense that the sum of 1 plus 2, which was minus 100, would be brought to 0 automatically by the market. That is, the market would clear by a change in the exchange rate. This would not happen when you have a fixed exchange rate regime. And this is where the change in the foreign exchange reserves part of the balance of payments comes in. When you have a floating regime, you don't need to do anything with your foreign exchange reserves. The government can just keep those dollars that it has in its coffers. It doesn't need to touch them. But when you have a fixed exchange rate regime, you're trying to defend a certain level of the rupee-dollar parity. That is, if you want to defend or keep the rupee-dollar parity to 58 rupees to the dollar, you do not want the exchange rate to depreciate beyond that. then you need to supply the additional dollars in order to sweep the excess demand in the market. So if the excess demand, which in this case was minus 100, because there was a minus 200 deficit on the capital account and a 100 surplus on the current account, the combination of those two is minus 100. The government would have to supply foreign exchange reserves to the tune of $100 million. And this would ensure that the exchange rate remains the same. If the government did not have these foreign exchange reserves, what would happen? Yes, the exchange rate would have to be abandoned. You would not be able to maintain the same exchange rate. The government can't have its cake, can't have the cake and eat it too, as the famous saying goes. It either has to give up its foreign exchange reserves in order to meet the excess demand for dollars, or it has to allow the exchange rate to be devalued or to depreciate. So this is the key connection between a balance of payments deficit, foreign market intervention by the government, that is when the government comes into the market and sells foreign exchange, or comes into the market and purchases foreign exchange. The example that I have just mentioned is the case in which the government has to sell foreign exchange into the market to meet the excess demand. That is when there is a negative sign on 1 plus 2. If there is a positive sign on 1 plus 2, then the government would purchase foreign exchange from the market, and that would mean that its foreign exchange reserves would be built up. So that is what has happened in Pakistan in the last 2 years, for example, that the foreign exchange reserves of the country have been going up because of a surplus on the current and capital accounts combined, and this has required the government to go into the foreign exchange market and buy the excess dollars in the market, excess supply, to bid up to sort of generate the demand for those excess dollars in order to keep the rupee dollar parity at 58 rupees per dollar. If the government did not do that, what would happen to the rupee dollar parity? Note that in this case it would not go up to rupees 65 to the dollar, it would go down to something like rupees 50 to the dollar. So I hope you've understood how the third category or the third sub-account in the balance of payments, that is the change in the foreign exchange reserves of the government, plays out when you have either a deficit on 1 plus 2 or a surplus on 1 plus 2. That is either the sum of 1 plus 2, that is the sum of the current account and the capital account, is in positive, that is it's in surplus, or it is in deficit, that is the sum of that is negative. And you can immediately see that when you have a floating exchange rate regime, the government does not have to worry too much about how it needs to make sure that the market will come back to equilibrium, because you've allowed the exchange rate to adjust to the point where the excess or surplus or the deficit or shortfall is all automatically eliminated through the price mechanism. But when you have a fixed exchange rate regime, then it is very important for the government to have enough foreign exchange reserves to supply to the market in the case of a deficit on 1 plus 2, and it should be able to purchase foreign exchange from the market when there is a surplus in the market. So that was about the relationship between deficits, balance of payments deficits, or the deficit on 1 plus 2, and the relationship between fixed and floating exchange rates and government intervention in the forex market or the foreign exchange market. Now let's turn to another important question that I said I would talk about, and that was the distinction between current and capital accounts. Now the current account is basically something which does not affect the liabilities or assets of the country as a whole. Let me introduce at this stage the concept of net asset position. आपको मालूम है एक चीज होते हैं असासे और एक चीज होती हैं जिम्मेदारियां. For those of you who studied basic accounting, this is analogous to assets and liabilities. Net assets of a country, or the net asset position of a country, is the net asase, the net assets that the net claims that the country has on the rest of the world. So anything that increases the net assets, the net claims that the country has on the rest of the world, will be recorded with a negative sign on the capital account. Anything which adds to your liabilities, that is reduces your net assets, would be recorded with a positive sign on the capital account. Note that the current account does not have any implication for your net asset position. So think of it like this. When you are importing a good from the US, you pay the money, right? And the good comes in, right? And that's the end of that. That is why it's called a current transaction. It starts today, it ends today. There are no implications for tomorrow. उसकी कल के लिए कोई खास अहमियत नहीं है. But if you look at a capital account transaction, for example, when foreign investment comes into your country, it generates future profit liabilities for you, so that in future, when that foreign investment firm makes profits in Pakistan, it will remit those profits back to its home country, right? And that creates a long-term liability for the country. Similarly, when you have a debt inflow, that is when Pakistan contracts new debt from abroad, then that money will also add to Pakistan's net liabilities, or it will reduce Pakistan's net asset position. And the implication of that is that Pakistan will have to pay interest on that, or pay the amount back in its entirety later on. Note that the amount that Pakistan pays in interest, or the profits that are remitted annually, will be recorded on the current account. That is, they will be recorded in the current account of the balance of payments. But when the original foreign investment is reversed, when the foreign investor takes the original money that he brought into Pakistan back, or when Pakistan pays the debt that it incurred, it pays it back, only then will the liability on Pakistan be removed. So this is how you differentiate between current account transactions and capital account transactions. Current account transactions have no implications for Pakistan's liabilities or net assets, right? Whereas capital account transactions have direct implications for Pakistan's long-term liability or asset position. It's useful to give the example of interest payments and debt. When you take on debt, then you can pay it back in two ways. That is, there are two types of payments that you can pay on that debt. One is the interest payment, right? The interest that is paid on that debt, which could be 10%. So if you borrowed 100 rupees, and if the interest rate is 10%, then you will pay $10 every year back. Let's say the loan is for 10 years. So you'll pay $10 every year for the next 10 years. But that $10 payment, whenever you make it, does not reduce the liability that Pakistan has. The liability that Pakistan has is equal to the $100 loan that was taken up. Unless that 100 loan is retired, the liability will stay. But when Pakistan starts retiring the debt through debt service, that is by retiring the principal of the loan that was taken, let's say Pakistan pays off $10 of the total 100 that was borrowed, not the interest, but the principal, then that causes a reduction in Pakistan's long-term liability to the foreign sector, to the US or whichever country Pakistan incurred its debt from. And that transaction will be recorded on the capital account. So when Pakistan repays debt or contracts debt, it will be recorded on the capital account. When foreign investment comes in or Pakistanis invest abroad, that will be recorded in the capital account. But when the payments on these foreign investment, the payments on this debt are made in terms of interest or profit, then those will be recorded on the current account. This is a very fine distinction, but a very important one to note. Note that when you have a surplus on your capital account, that is, more money is coming in, there is also a negative connotation of that. Because, as I mentioned earlier, whenever there is a plus sign on the capital account, that is Pakistan taking on more debt or more foreign investment coming in, those add to Pakistan's liabilities, right? They are not additions to Pakistan's assets. वो आपकी जिम्मेदारियों में इजाफा है. Because you have to pay that debt back. That foreign investment that has come in is a claim on Pakistan's assets. So it's a liability for Pakistanis. So a surplus on the capital account not so good, be careful. But a surplus on the current account, that is if your exports are more than your imports, very good. That's a good thing for an economy. This is very preliminary or basic discussion, but it's important to understand the difference between a current account surplus and a capital account surplus, or a current account deficit or a capital account deficit. When a country has a capital account deficit, for example, that is, it is giving out more money outside than it is bringing in. That is, it is giving out debt to other countries. Like, for example, Japan has a huge capital account deficit. This does not mean that it is bad for Japan. It means that Japan has excess money that it can give as a donor to other countries. So it can distribute aid to other countries. It can give out loans to other countries. It can invest in other countries. And that means that Japan's overall net asset position relative to the world is improving. When your capital account is in persistent surplus, this means that your overall liability position is worsening. But when your capital account is in deficit, it means that your overall liability position vis-a-vis the rest of the world is improving. That is, your net asset position has become better. So with that discussion in mind, we can turn to the final question that we will address today, and that is, what does balance of payments equilibrium mean? When I said that the balance of payments always balances in an accounting sense, this might raise the question that what does balance of payments disequilibrium then mean? If the balance of payments is always equal to 0, that means that the balance of payments is always balanced, that is in equilibrium. But this is not the case. When we are talking about balance of payments equilibrium, we are usually referring to the equilibrium in the individual subcomponents of the balance of payments. So if, for example, a country has a very large current account deficit and a compensating capital account surplus, that is, its imports are very high, its exports are not so large. So let's say its imports are 200 million, its exports are 100 million, and there is a gap of 100 million, that's a current account deficit of 100 million, then the government can try to borrow from abroad, that is, it can try to cause a surplus on the capital account, that is, increase its liabilities and finance that current account deficit. So it can raise $100 million from abroad, and that will finance the 100 million deficit on the current account. This will mean that the sum of 1 plus 2 will be 0. But is the balance of payments intrinsically in equilibrium? It might be, only if the current account deficit does not remain at a level of minus 100 or increase from that level in the future. If the current account deficit is going to be minus 100, minus 200, minus 300, minus 400 or minus 300 continuously in the next 10-15 years, then how will the government be able to borrow increasingly in order to finance that current account deficit? After a while, the borrowing window will close. Foreign investors will not come to Pakistan. They'll say that this country's current account deficit is in a mess. This country is importing more than it can afford, that more than it is generating export revenues for. So the borrowing window will close. Foreign investors will lose their confidence. They will not invest. And therefore, the country will move towards a state of balance of payments crisis or a balance of payments disequilibrium. So whenever we refer to balance of payments disequilibrium in the context of developing countries or lower income countries, we mostly talk about the current account balance. If the current account balance is in surplus, it's good. If the current account balance is in deficit, it's bad. I mean, it might be, and we'll discuss it, that a mild current account deficit is good for a growing economy, but a very high current account deficit is usually not considered good, because it's not possible to continue financing that current account deficit through capital account surpluses. So my friends, with that we come to the end of today's lecture. We've covered a lot of things today. We've understood balance of payments accounting. Before that, we looked at how the market for foreign exchange operates when you have fixed exchange rates and floating exchange rates. And that analysis helped us understand the relationship between the third part of the balance of payments account, that is the change in reserves part, and the first two parts, that is the current account and the capital account. We also looked at the distinction between the current and capital accounts, and we will develop this further in our future lectures by looking at the exact determinants of current account balance or current account surplus and deficit, and capital account surplus and deficit. Till our next lecture, go home and revise these concepts. They are very important, slightly difficult, but they are, I think, within your remit of understanding. So we'll meet inshallah in our next lecture. Till then, Khuda Hafiz and Assalamu Alaikum.